Hello, everyone, and welcome to another episode of Living on Blockchain. Today, we are speaking to Rorke from Theia Finance. He's the CTO there, and Theia Finance is building a very, very interesting permissionless protocol. Basically, think of it like a Web3 ecosystem, which is for creators and by creators vis-a-vis investments. This was a very interesting conversation in which he went into details about how Theia Finance is gonna disrupt this particular niche that we have in Web3. So I can't wait for you guys to hear this. Let's deep dive right in.
Hi, Rorke. How are you today? Thank you so much for taking out the time to speak to me.
Hi, yeah, thank you. I'm doing well.
Lovely. So, just for our listeners, can you tell us a little about yourself and, how you got into the Web3 space?
Yeah, sure. So I think the place for me to start is, I obviously in high school and when I was a little bit younger, I think my engagement with a lot of Web3 elements was maybe like using Bitcoin for some, I wouldn't say the nicest, like above board purchases, right? But, obviously, regrettably, I've probably had a lot more stacked around that I spent as opposed to, held on to. So, but, that's all part of the fun, right? But
yeah, we've been there, done that. So, I've done that with Ethereum. Yeah.
Yeah, exactly. But I think really where things kicked off in a big way was in college. So I studied computer science at Dartmouth College. And it was a specialization in augmented and virtual reality design and development. So it was really a computer graphics degree. And during, my time in the initial stages of that, I really latched onto the tech and the concept of working at the knife's edge or something. And kind of, school projects turned into personal projects and projects for friends. And soon enough, projects for friends turned into Discord groups and then other Discord groups. And I was kind of rubbing shoulders anonymously with some of the guys who were doing some of the heavier lifting of a lot of leveraged digital assets earlier on. Like I was a minted, one or two not sandbox, Decentraland plots, back sort of 2018, 2017 territory. And then also, after that, I was kind of always in the loop and kind of got to take things from the VR angle. And as a result of kind of being in the loop, I was very much there for much of the initial, like, big PFP mints, like the, sort of like the 8 mint on the NFT side of things. And then also like rolling that into like the DeFi summer and the kind of wild part of that. And obviously that's a lot of fun. Like, you just get to be financially involved in something that just kind of goes a bit ballistic. Right. But I think coming from where I'd come from, I really got to overthink a lot of the use cases for the tech, especially something like, the NFT standard. And I knew that there was going to, or I at least kind of expected that, okay, as with a lot of things in Web3, if it gets adopted in a big way at all, there'll be a big wave of speculation that kind of flows through and things get a bit nutty. And it'll be difficult to parse between what's legit and what isn't. And that'll kind of, drive the adoption cycle in a positive way, but then have some negative consequences and all of that. And so I kind of rolled with that for a while personally, and then was actually able to roll my personal portfolio into starting a hedge fund with some traditional finance people out of New York, which I run now. But really where I think, what I'm kind of building with a couple of guys is kind of came to be was the concept really started in July of last year. Okay. I was in New York and a friend of mine who's actually become my co-founder, I'd known him since freshman year, but he was at Columbia. He had come to me and, we were talking about what I'd been doing in the NFT space. Because obviously at that point it was quite, if you were at all around, it was still, it was a pretty hot thing. And, apes were around like 50 ETH at that point. And so and actually the more important thing is that there had also been some notable rugs at that point as well too.
Right. Yeah.
And so he had come to me about this concept that his friend from high school had come to him about, basically this protocol. And he just wanted me to give a look over about it. He just wanted me to, because I had a little bit of market experience, he was just like, well, and also a bit of technical experience. So he was like, first off, is it feasible? And then also, how would it fit in the market? And so I kind of had a look over about it. And, the initial bones of what it was geared towards something different. But then over time, I kind of worked with the kind of brainchild originally. His name's Nikita, and Lawrence, just getting an advisory role, like suggesting, oh, here you could do this, this, or this, or this. And soon enough, we kind of figured out the addressability for this protocol was much larger and could actually solve some pretty significant issues in that were kind of popping up in the Web3 space, much of which to do with like accountability, trust required in a trustless system. And, we kind of went from there. And, I think I think we started really building protocol out in full September, and we kind of haven't looked back since. So it was a really weird way for me to walk almost through the back door into Web3 and kind of start in a really isolated area, and then start as just somebody who all I did was computer graphics, and then sometimes I'd hand stuff off to people who were doing actually a lot of the technical heavy lifting. And then I came in as financially as an investor, and then a collector, and then I kind of moved to the builder sort of stage. And now ever since it's kind of been, that's been full force, and so I've been all in on the whole thing.
Wow, that's quite a journey. As you mentioned that it's a roundabout way of getting into it, but you got into Web3 all right. So here in the white paper, I was going through it. It says that it's basically Theia is like a decentralized investing and trading protocol, right? Where you are aiming to create this by the creators and for the creators and builders of Web3. Could you tell me a little more about this protocol? Like, how can the creators be involved, with this particular protocol? And has the testnet been released?
Yeah, so we actually have our V2 testnet just launched to our alpha testers on Friday.
Okay. Wow, congratulations.
Thank you. Yeah, appreciate it. So far, everything's going okay. The whole ethos of the protocol, it's about realigning incentives between founders and investors, basically. So there's two parts of Theia, two main parts. I want you to think about it as like a two-tiered structure, really. Okay. There's this novel investment protocol, like the actual protocol layer. And then built on top of that, there's the DApp layer. That's the actual social investment platform. Now, we'll talk about the protocol first. So the protocol, really, it's, again, about aligning incentives between founders and investors. And that means kind of aligning accountability as well. And so how do we kind of achieve that? The biggest problem that I found, pretty much everybody found, that interfaced with in Web3 was the concept of, money up front, deliver later, right? So, if it's an NFT drop, if it's an ICO, if it's whatever, basically all these investors are giving a company a ton of money up front on the assumption that they'll take that money and then give utility and build something for the asset that they get in return, right? So whether it's a token or an NFT, you're kind of giving that money on the assumption that what I get in return will appreciate significantly. And that's got a couple of problems, right? Like, one is obviously the accountability, right? Like, you could just, we've seen it, right? You could just run away with the money, like, and there are some pretty famous examples in the NFT world, whether it was Evolved Apes or Pixelmon, which was like 70 million, and obviously ICOs, it's just every other day. Now, then there's also the problem of the fact that, when you're an investor, a project and you launch an ICO or even an NFT drop as like an artist or a musician or something, you're kind of adopting the shortest term pressure to perform right out of the gate, right? Like if you don't sell out your NFT mint, if your ICO doesn't have enough liquidity, or some guy who's just looking to make a 5% margin comes in and buys up your initial sale and then dumps it on the market later, you basically, your company or your project is in the ground. There's no recovering from that, right? And so it's just not conducive to healthy projects or company building. And so what we did is we basically created a protocol that creates a degree of separation between the project's native asset and the investor. So we have this smart contract. So when a project comes to the platform, what they do is they deposit a certain amount of their allocation of their native asset. Let's say it's a fungible token for simplicity's sake.
Right. Yeah.
They'll deposit, let's say, 10% of that token into our smart contract. And then at that point, and then when an investor comes to invest in that project, they invest into the smart contract that represents the project. They are not buying the project's native asset directly from the project. And basically they can invest whatever cryptocurrency they want. And so when they do invest, the smart contract mints representative project tokens. Now, the key intuition there is that they're representative of the project. You're not buying the project.
So like synthetics.
Yeah, like synthetics. Yeah, think about it like that.
Yeah.
And then because we have that degree of separation and we're minting these synthetic tokens, we can set some rules for how those tokens behave and how the whole process behaves. So as a result, when somebody invests, not all of the money that they invest with goes to the project up front. It's actually a small amount. So a project sets what's called a commission rate that could be no higher than 20%. Let's say it's 5% in this example. And somebody invests $100. In this example, $5 would go to the project upfront. Now that is their money to do with whatever they want. The $95 gets locked in the smart contract. And basically, the protocol uses that $95 for is if an investor is, losing, he doesn't really feel what the project's doing anymore. He's losing confidence in it. He can sell his representative share, his representative synthetic tokens, back to the protocol without the need for a counterparty. And the protocol will buy back his tokens, and in pure isolation, it'll give him back like basically the $95. Now, the way that the project sees that $95 is that the investor, after a certain criteria is met, which I'll go into a little bit later, but an investor has to convert on his own time his representative tokens into the native asset. So basically, he will convert his representative tokens, foregoing that guaranteed liquidity. And when he does that, he gets the native tokens, a proportional share of the native token allocation in return. And then that $95 gets unlocked and sent to the project. As a result, that basically, because the project's not receiving all the money up front. If it wants to receive the rest of that money to continue, it has to prove to investors that they're both above board and then also can deliver and are building a project that's worth, staying involved with. And so basically, with that whole system, these representative tokens are also priced according to a predictable price algorithm. So we price these, each project on Theia has its own customized bonding curve AMM that's basically built into the smart contract. And so when
Okay.
any token is minted in the event of a sale, the next token bought or sold back to the protocol is more expensive. And then anytime one of those synthetic tokens is taken out of the market by way of a sale and effectively burned, the next token bought or sold is less expensive. So actually, these representative tokens trade, they can kind of trade and result in kind of organic price discovery over the long term. But the important intuition is that there's always a symmetrical relationship between the liquidity available in the pool of the project and the market cap of the project itself, because investors are basically underwriting their own liquidity. And so because we price this according to that mathematical bonding curve, we can create a mathematical cover in which there's always enough liquidity in that project to cover the sale of every single representative project token that represents that project. So if all the investors decided to sell, nobody will ever be left holding the bag. You will always be able to sell for something. And so as a result, there's always that symmetrical relationship between the total invested volume, aka the market cap, and the actual available liquidity. And investors can always they always have the option at the door. So that's kind of the intuition, is that basically these projects, you come to the platform, you set three main parameters as a project, one of which is your commission rate, the other of which is what we call a minimum funding threshold, which is basically the minimum amount of money that your project needs to raise up front before you can start entering basically a proving stage, so how much money you need from that commission. And then the third one is the length of what's called your conversion period. So I spoke about how this kind of converting works, but the conversion, we don't want to put that all into one event, right? Because then that induces a lot of FOMO. It kind of constricts things, and you basically, as an investor, you want to make sure that when you expose yourself to a project, you can do it at your own time and when you're fully confident. And so what happens is that a project sets what's called a conversion period, of which it's advantageous for them to set it, over a long period. So let's say it's over a year.
Okay.
Basically, what that means is over that year, the allocation that they put into the smart contract, let's say it's that 10% of their token distribution, gets split up into 52-week chunks. So basically it gets split up into 52 chunks, one per week.
Okay.
And so every week, investors have the opportunity to convert a proportional amount of their representative tokens. So again, 52 chunks of the representative tokens for a potential share of the real thing. And if they don't, then their allocation gets rolled into the next week and the next week and the next week. And the idea there is that this whole period is like a vesting period, but instead of the tokens being paid out automatically, they're basically paid out when an investor decides to commit to the project fully. And so that during that whole period, it's on the project to basically can constantly be proving themselves, whether it's if it's a protocol, it's maybe a beta test or a code audit, or the protocol being built, or if it's a play to earn game, it's like a demo or a trailer or whatever. If it's an album, it could be a single. But the point is that it's at that point you're proving to investors that there's something here, and then investors can convert their tokens, and then that's when the project starts really receiving the majority of the money that they would raise, and then you kind of go from there. And so that's kind of the protocol layer. I know I threw a lot at you there, but
no. So let me break this down for our listeners, people who are sort of chiming in. So this is your protocol is basically think of it like an on-chain lock-in sort of a system, except that, it's based on milestones. It's pretty much like, if I'm getting this, like, correct me if I'm wrong, but in traditional funding on, at times when people are doing like equity funding, there are milestone-based trenches, right? Like there is a whole amount of money that you raise, and it's based on milestones. And once you achieve those or you hit those goals, only then the rest of the money follows. So you are doing this on-chain, correct?
Yes, but the that's a good way to think about it. But the important thing to note is that there aren't specific milestones. The milestones are really for each individual direct investor can choose when they decide to give them the rest of the money. Okay. And so it's really a personal decision. It's just like, you know what, like I feel like I like what this project is doing. I'm ready to commit, and that can be a totally personal decision. That decision's never made for you. And if you don't, or you can say, you know what, I don't like what this project is doing, let me get out. And then the protocol guarantees liquidity for everybody. So you can liquidate your investment, sometimes always for less of a loss than you would have otherwise if you're just holding the bag. You could even leave flat on your investment, like you never, even made a loss to begin with, or you could even potentially make a gain depending on where you invested initially and in the market and all that. And so, that kind of idea of always having the door just creates a healthier, situation for investors. And
right.
And
So, but basically, it's like it's good for the investors as well as the protocol, the platforms themselves that are coming in to raise the monies, because they always have that push to actually go ahead and build, rather than, it can be a good motivating factor. Would you agree?
Right. Yeah. That's a good point. Yeah. I think our pitch to a lot of projects is kind of threefold. One of them is really the idea of like, you guys don't have to worry about like nailing a 24-hour event anymore. Like this is it's a real big pitch to like musicians or artists, or we're trying to maybe onboard onto Web3 in some way. But, like if you're trying to do like an NFT mint, especially if it's a PFP or something, if you don't sell out your mint in 24 hours or like 48 hours
then consider
maximum,
a failure. Right.
You're dead in the water, right?
Yep. Yeah.
And that's just, it's unnecessary. And so for us, we allow your project to organically accrue value over the long term there's no rush, right? Because, your project only starts converting when you've raised, when enough money's basically been locked in the project to begin with anyway. So, it's all about value accrual and organic price discovery and the kind of these elements of communities coming together around a project, but that can all happen in an organic way over the long term. And so it's a much healthier dialogue. And also a more important thing too is because we kind of shelter early stage projects from the greater speculation of the market, right? We kind of have this little cove where we have, a little bit more consistent of a system. If it's an NFT project, you don't have to worry about these aspects of post mint where if your floor price starts to fall, 5%, it almost looks like the end of the world, right? You gotta, suddenly it's red alert, and if you don't act now, and if you don't somehow do something, your project's dead again or something. If you make a mistake, if you make one mistake, your project's dead. On our platform,
absolutely.
You can take that dialogue with your community, almost subconsciously, like in the way in which investors come in and come out over this whole period is a really good way of showing like, okay, this is the direction I need to go. This is what I need to avoid. This is, good and bad. And so that's why we really love the concept of social investing. We have it everywhere in a white paper. We have it everywhere on a website. And we think it's a phrase that's been thrown around a lot, especially in Web3, but hasn't really been defined. And we really think that element of network-based investing or communities coming together around a project where it's, you take an active participatory role in the project and community success along with your investment is really an important aspect. And so we really gear the platform for that. But that platform and that environment can only exist if you have the necessary parameters for it to do so. And that's really what the protocol is all about.
Interesting, very interesting. So then, we can think of this like a republic, but perhaps, on chain and with a certain community element to it, that, you're kind of easing it out for the projects themselves and kind of opening a few doors for them, right? Because even though Web3 it's a small niche and, it's a global community, but then again, people who are coming in from Web2, they don't know what are the kind of elements that go into Web3 because they're so drastically different as against, what was happening in Web2.
Right. Yeah, exactly. Like we're building this platform and the protocol as well to help onboard the next, 10, 20, 30% of the world that onto this space. Right. And we know that there are a lot of prohibitive elements. Like one, if you're trying to invest in something in Web3, there's so many things you have to juggle. If it's like if you're investing, by buying something on a DEX, you have to think about like the project, but then also the economics of the DEX, how much is in the liquidity pool, like is it third party liquidity, who's offering the liquidity, like who owns what, like what's the tokenomics, like there's so much that could go into your investment that's kind of white noise almost. And we try to eliminate a lot of that, at least the very earliest stage. So all you have to worry about really is just, well, do I like what this project's doing? Do I like the vision? Do I like the team? Do I like, the product? And that, drives
there are so many things to actually check. Yeah, exactly. There's so much due diligence that a user needs to do. So you kind of like doing it for them, and they would also come with that kind of confidence, right?
Yeah, so a really important thing you said there about due diligence. So I'm going to speak a little bit on the platform side of things now. So as I mentioned, there's kind of a two-tiered structure. Now, think of the platform as having a two-tiered structure in and of itself. There's projects, and then above that, we have things that we call collectives. Now, what we've done is we're effectively decentralizing the due diligence process. So as we've seen with a lot of, like launch pads, for example, launch pads we think are a really antiquated solution to like Web3 fundraising, because if you launch pads are a lot like accelerators. They're kind of reskins of that. They're a lot like incubators in a kind of a similar way in how they function. In that, what ends up happening is that you have a launch pad. Let's say something like Avalanche on Avalanche, or like Binance Launchpad or something. You have thousands of projects, like thousands, that all apply to this launch pad.
Right.
And this launch pad is this totally centralized form of due diligence. And they got a team, it could be like 5 or 20 people that do the due diligence on projects.
Yeah.
And as a result, they can only really address so many projects. They're probably chain specific, and then also like sector specific. Like they're like, they can only really worry about crypto projects, and then really only certain kinds of like DeFi protocols, maybe. They can't like worry about, they can't think about play to earn games. They can't think about, these musicians, or that's just out of their possible range. And like, don't get me started on a lot of like the micro investments that have started in crypto. And so as a result, we wanted to create a system in which we could have a platform that addresses all the verticals individually. So as a result, we created these things called collectives. And so what collectives are, is they are DAOs that do due diligence and actually onboard projects onto the platform. So basically, when I create a project, initially my project is unlisted. And in order for my project to become investable, I basically apply to what is called a collective. And the collective can, look at my project, look at what I'm doing or whatever, do whatever due diligence that it wants to do. And then basically, if it gives me a thumbs up, and then I give a thumbs up that I want to be on that collective, I then get onboarded onto that collective, and that collective becomes the sole destination on the platform for me to invest and for anybody to invest into that project. And the intuition here is that collectives act as like sponsors. They're basically, putting their sign of approval behind this project, like, hey, we think this project is worthwhile, you can invest in it. And as a result of doing that, collectives set a commission rate, a flat commission rate for every project that they onboard. So let's say a commit, again, they set 5%. So any single time, a dollar goes into any project underneath, that collective, they take 5%. And so it's revenue, basically. So they're rewarded for onboarding high quality projects that receive consistent investment volume. And they're punished if they don't, because, and so the point there is that they can be, these collectives, anybody can create one. They can be around the tightest verticals as you want. Let's say I'm just an expert. I'm so passionate in, play to earn games, but more specifically like play to earn idle RPGs, like a really specific genre.
Right.
And that's all, that's my bread and butter. I know all about it. I know the market. I know everything. And I know what's a good project and a bad project. I know what's a good game. And so, and a project can come to me, let's say I'm somewhat influential in the space, and instead of just shilling their project on Twitter, they can onboard it onto my collective, and you kind of get that combined element of here's the seal of approval. I put my name behind this, but then also, I give it an immediate destination to invest into that project. And I stand to earn from doing a good job as a curator, basically, and onboarding, legitimate good projects. And yeah.
So
and
like,
so,
if I want to just butt in and ask you for the other side of things, like, okay, you have these collectives and you have these investors, which are like end users. Right now, are you actively onboarding either like users as well as like perhaps DAOs or creators on?
I'm really glad you asked that. So a big part of our go-to-market strategy is, we have three things we have to address. We have the collectives, who are curators. We have the projects, themselves, and then we have, the investor community. Obviously, in the full state of the project, it's a fully permissionless platform. Anybody can create a project. Anybody can create a collective. Anybody can invest in anything as long as you have the wallet. However, we want to, and we have a solid incentive structure to make sure that quality rises to the top. However, we want to come out of the gate, with when we hit the permissionless launch, with leading the way with quality, basically. And that means from every stage. And so as a result, we've spoken to a lot of DAOs, crypto communities, like dev teams, also platforms in and of themselves, about potentially being part of our basically beta launch. And so we're to make a long story short, how we're moving to our permissionless stage is we're decentralizing in stages. So we start, our alpha launch when we push to mainnet is basically the platform becoming the principal collective. So we onboard a pre-curated list of about 10 to 15 projects, of which we're really happy with the short list. And then about a month and a half later, we'll do our beta launch, in which we onboard a curated selection of collectives. Basically, we've gone out and we've made some partnerships with some big organizations and DAOs, in which they can become some of the earlier curators, and they already have a short list of projects that they want to onboard. And then we'll hit the permissionless launch, in which anybody can now create a project, anybody can now create a collective. But we've grown the investor base to meet those stages kind of throughout that whole process. So kind of to give some examples, some of the one of the big addressable markets that we're trying to address is the art and music industry, because we love the idea like fractionalized music NFTs being leveraged for royalty rights. Like we like that idea of okay, you can fractionalize an NFT that represents a song or an album. And then, with a little bit of infrastructure down the road created by like Spotify or, YouTube even, you can divert the streaming revenue into that fractionalized NFT and then partition it correctly, right? We really like that. We think that's like a really, really cool
that is very
vehicle
cool.
for musicians to kind of, again, avoid the middleman, to not have to like be to kind of screwed from a record label or something. And
right.
But for our platform, the intuition there is that like a musician wants to create an album, but they need a little bit of money for some studio time. And so they come to our platform, they create a project, they allocate a fractionalized NFT to the smart contract, and then they hit their minimum funding threshold, they release a couple of songs, and everybody converts, the album's created. And then the ownership of that album in terms of revenue rights is distributed as well. And so that's like a really nice way in which, again,
that's a wonderful use case. Yeah, that's a wonderful
use
case. They kind of, completely leaves out the middleman, and they would, because this is so like, we are in tech. So we understand all this, right? But, for people who are perhaps just creators and they're already doing so much heavy lifting, right? They're creating something beautiful. This is not their domain expertise. So, for you to come in and give them that kind of simplifying it for them, that is a beautiful use case.
Yeah, exactly. It's just, it's more important for them, like if they wanted anybody to own something that they've created, it's the community that supported them, right? That's a big thing. And so that's kind of what we want to allow. Now, there are platforms that, do this, that support musicians, that support artists in onboarding onto Web3. They'll help them, like Hi-Fi Labs is a good example, SoundMint's a good example, both of which we've spoken to. And, or Open is a good example. They basically onboard, they help a musician with like an NFT drop or NFT utility or building out that whole ecosystem. But the problem is that they have to address each artist or musician one at a time.
Right.
Because it takes so much resources, so much effort to fulfill a successful NFT launch because it's a one-day event. It's like, if you don't get it right and you don't fulfill it, then it's all been a waste of time, and the investors who did commit feel a little cheated out, and the project doesn't go anywhere, and that's a really, that really constricts these platforms and these communities from the amount of people that they can support. So they see something like us as, okay, we can still support like these artists with a lot of the technical elements, a lot of the, how do you want to build your utility, advice, all this kind of stuff, promotion, but we can onboard more artists at a time because they can accrue the value of their user base in their project over time, basically. And
wow.
And so it's not like it's a much healthier way, and investors, because again, they can always liquidate.
Also.
Yeah,
it's
exactly.
A sustainable way, right?
It's sustainable, and they don't have, exactly. It's not this high stress thing where they're constantly moving from person to person to person. They can take it in a much more organic way. And so we, Hi-Fi Labs is a really example of what may become one of our principal collectives, along with SoundMint. And we love SoundMint because they've been doing a lot of the heavy lifting on like fractionalized NFTs for royalty rights and mixing that with the legal elements and all of that. And also art and visual music NFTs coming together. And so then beyond that, we have some other ones. Like a good example of another industry vertical that we're trying to target are basically metaverse developers. So, we love micro investments. We think that's a big part of Web3, where not everything's a company, right? Like not everything's a company, not everything's like a project that'll be this huge, long-staying thing for the end of times. There's so many situations as an investor where it's a quick in and out thing, right? It's a one-time thing. It's like we're I'm buying a plot in the sandbox with like 10 other guys or whatever, and we're fractionalizing it, or we're building we're building a mansion for Snoop Dogg in the sandbox or something, and it's just a quick thing. It's like just a one-off in many ways. And of course you can hold that asset for the long term, but it's not like a company. That's basically what I'm saying. It comes to completion. And so,
Right.
metaverse developers, guys who come into things like NFT worlds or Sandbox or Decentraland and basically build or architectural firms for them, really cool teams. So there's stuff like Meta Labs or Webverse are guys we've spoken to, and they have so many projects for like, hey, we're a team that is, we want to build on this plot. We want to put in a bid to build for this person, but we need a bit of money to hire 2 more architects or whatever. And then the intuition there is that you then distribute the rights, either the payment or the ownership of the final project or whatever to the investors. But again, the people who know that industry best are the developers themselves, and so they would create the collective around that. And so that's where it's kind of like by the creators for the creators. And then also,
absolutely,
another industry is like or that we love is DAO tooling. So obviously it's all the rage to create DAOs around millions of different things, and we love that. And we especially love DAOs as a solution for nonprofits, making sure that their financials are more transparent than they currently are in the world. And so there are platforms like XDAO is a really good example that are DAO tooling systems. They basically help DAOs and give them the tools to manage their AUM, like manage their treasuries, manage governance, in a nice and easy interface. But again, there's the one problem that they can't really address with every single DAO that comes to the platform, which is raising the actual money. Like if you want to have a DAO that has a treasury, whether it's an investment DAO or a even a nonprofit, or even like a DAO that's trying to purchase something or whatever, there's that aspect of pooling the money and then distributing the DAO tokens accordingly. They look at a system like us as another way for those DAOs to perpetually come together, and then for the money to be brought together, and then the DAO tokens that represent the governance and everything to be distributed accordingly. So that's a really exciting thing for us too, because you can look at a DAO that's whether it's something that was like Constitution DAO or a lot of DAOs that were like MBA DAOs or whatever, but you can that community can come together over time. It's not again like a one shot only thing. And then when the community's ready and the money's there and everybody's ready to go, they can convert to commit to it basically, and then the DAO goes off to do whatever it wants to do, and it's a really efficient and healthy way for these DAOs to assemble. And so then, but again, who are the guys that know what some of the best DAOs are going to be from a functional standpoint, governance standpoint, like objective standpoint, all of that? It's something like a DAO tooling platform like XDAO. That's their bread and butter. That's what they know. And so they can start the principal collective around, DAOs or DAO formation, and then onboard DAOs that they're passionate about or that they feel should get support and deserve support, and then earn as a result of doing so.
Wow, that's very interesting. Actually, post this particular recording, I'm going to connect with you, drop you a line. There's been a DAO idea that we've been tinkering with, like an investment DAO, but for basically underrepresented founders. And perhaps, yours is the platform we can look at, because, you guys can take over basically the part that will cause us headaches, and we can build on the network, and, you can help us with the nitty gritty.
Yeah, of course. Love to, throw some things around. Yeah. And, one more thing about, I think like you kind of said something there that's really important, is as a founder, all you want to, like, building something is hard enough. Like building something that's worthwhile is hard enough. for us as a company, in a platform, we're in the middle of, raising a seed round, right? And
Right.
it's been an extraordinarily frustrating process.
Yeah.
You're speaking, it seems like all your chances of whether or not you continue on as a project and get to where you want to be, or you fail, are because it's a Tuesday and the VC partner you're talking to had a fight with his wife or something, and he's just not feeling it that day. It doesn't want to commit or something or whatever. Obviously there are, these people try and treat things and be objective, but they have, they're good at what they do, but it can seem like there's so many things that are just unnecessarily complicated and also detract from you as a builder. Like, we've had to put so much focus into our raise that we have to check ourselves to make sure that we're not neglecting the development of the actual product. And
no, that I think
that's
almost always happens, right? Like if you're raising money, that's like a full-time job, right?
Yeah, exactly. And that's something you shouldn't have to consider as much. Like, sure, you want to make sure that if you do have investors, that you give them confidence and all of that, but that should come from your product. And so we really want to make sure that creators can all they really have to worry about is just continuing to create something great. And because that's hard enough. And also
it's great that just sort of what you said, that what raising money is. Building something is hard enough, and then when you're going out and doing this entire raise thing, and I've done like several raises, and I know how bloody hard it is, right? What you said, that at times the other person is having a bad day and you bear the brunt for it for no reason, right? And then it kind of derails your motivation. So what you're building here is like facilitating, right, for these companies and these platforms. It becomes a little easier, helping hand. And I think Web3 is so much about just that, sort of leveraging the collective intelligence as well as the community to make sure that we are able to build, good things and beautiful solutions faster.
Yeah, exactly. And that was a much what we thought was a lot of the original vision behind these kind of decentralized systems. And the initial ICOs really spoke to that, right? They were great. I think everybody involved was passionate about what was going on, and it was a kind of a tighter community. But there were some great companies that just came out of ICOs, but obviously over time, because there were misaligned incentives and inefficient capital systems, that dialogue started to get polluted a little bit. And so we wanted to make sure that, still through a trustless system, not through a centralized means, we brought investors and founders back to eye level. We really think that that's what Web3 is all about. And, we want to make sure we can enforce that in a trustless way and allow for that kind of healthy dialogue to occur. And another kind of aspect to note is that, when I speak about collectives are also an investable asset on the platform. So basically, we duplicated the pricing system for these representative synthetic project tokens for collectives. But when you invest into a collective, you receive what are called collective tokens, shocker. And these collective tokens can be bought, sold back to the protocol in the same way. However, they have an extra layer of utility to them. So collective tokens can be staked back into the collective that they represent. And when you do that, you get two things. You get proportional governance rights in the thumbs up, thumbs down decision. So you get your voting power for, yes, I like this project, let's onboard it, or no, this project shouldn't be on our collective, is proportionally weighted to how many tokens you've staked in proportion to the whole. And then also you get a proportional share of the revenue that the collective earns. So these collectives are really, they're designed to grow into communities. They may start around like by one person or a community of people around a vertical, but then the idea is that they accrue all the people that are passionate around that vertical, and they all can kind of take
be
part.
A little like a syndicate, perhaps.
In a sense, yeah. But because these collective tokens, the supply can be infinite, even though the price will get more and more expensive, so they can be prohibitively priced eventually. In theory, these collectives can grow. They can grow, and we really want them to grow around the identity that they were initially formed by. And because they grow and they accumulate, more members, the accountability of the collective becomes more robust, because not only as a person staked into a collective do you potentially stand to earn from the revenue that the collective earns from onboarding good projects, but also you're the holder of an asset that can appreciate or depreciate based on that performance as well. And so we've designed the platform from an interface wise to be both extremely easy to use. We want it to be really clear, really transparent, really easy, only relevant information, user friendly, human-centered design, all of that, but also transparent is a really big part of what we're doing. So anytime you go to a project, the project's page, you can see how the project's tokens performed in terms of price. You can see how many investors are in the project, who's invested into the project, for how much each individual investor is invested. Like I own 20% of the project tokens, this guy owns 5%. How many of the tokens that X investor is converted once you get to that stage. And it's the same really for collectives. You can see who owns how much of the collective tokens, who has staked how much, what their voting power is, what their rev share is. And then as a result, you can see the performance of every single project that collective's onboarded as well, because collectives as a financial vehicle, they actually act very similarly, albeit in an analogous way, to an ETF. They're kind of a de facto ETF, because what they do is, because they set that flat commission rate for all the projects underneath them, and that commission is from basically determined by investment volume. The collective, if you were to invest into it, is a lot like investing in, into the S&P. You're basically betting on the performance of 20 projects, or however many projects that are underneath that collective. And if any one of those projects starts to, is basically cut off because maybe the project is starting to look like a rug and investors just get out, or they don't like the project anymore and they sell, and then nobody starts buying in anymore, that project basically becomes like a dead cell, but it's still on the collective and it's for everybody to see. It's, so if a collective decides, onboard something that's bad, whether it's malicious or just of poor quality, they are negatively impacted by that, because they earn less revenue, and as a result, fewer investors want to basically potentially get a cut of that revenue, because there isn't as much to go around, and it costs too much because that collective token is now priced too high. And so some people would start offloading their collective tokens because it's not a worthwhile investment anymore, and as a result they start to depreciate, and so on and so forth. So it's basically, you're incentivized twofold as a collective to onboard high quality projects that receive consistent investment volume. And that one of that is in the form of the revenue that you earn as a member of that collective. But then the second part is the tokens that you hold. It's like holding stock in a company.
Right.
But that stock price isn't driven off of pure speculation. There's a clear and precise pricing mechanism that, is basically conducive of who's present and who isn't present in that community. So it's in your best interest to both want to entice more and more people to want to come to your community, but also entice investors to invest in your projects. But you have to act in investors' interest. So the important thing there is that for both collectives and projects, they are acting in investors' interests always, right? Their priorities aren't just let me raise as much money as I can for what reason. They're always making sure that they're giving investors the most amount of confidence in them. And so as a result, because anybody can create a collective and anybody can create a project, we envision like a competitive atmosphere on the platform being created, right? Like, obviously a guy will create a collective around, play to earn games, but I'm sure another person will do the same. And then it's about, well, which collective is better? It's like, okay, well, the collective that's better is the collective that onboards the better projects. Then it's like,
absolutely.
Okay, so now as collectives, I'm competing for better projects. Okay, but then also as a project, I want to get onboarded onto the hottest collective because that I know what that means from a social standpoint. If there's a really influential people in that collective, if they all basically give their sign of approval to my project, it's like the ultimate like thumbs up. But also I know that collective gets a lot of investment volume. So if I want my project to to get a lot of investors, I want to be on a good collective. And so basically collectives are competing against each other to get the best projects, and projects are competing against each other to get onto the best collectives. But the important thing is that they're competing for investors. They're competing for investors' interest. And so everything has to be tooled for both giving investors the conviction to invest, and then more importantly, giving them the further conviction to stay invested, and then more importantly, convert their investment.
Oh, okay. So, because now we're kind of running out of time, but I'm just going to summarize this, which is best of my ability. What you're creating with Theia is basically a Web3 ecosystem for creators, investors, and as well as perhaps syndicates at some point to ensure that, the fundraise process does not take away from beauty and, the enjoyment or the journey associated with creation.
Yeah, that's perfect. I mean, that's really, we want to help fuel the next stage of Web3 adoption. And a lot of that has to, in order to do that, we have to break down a lot of barriers to entry, whether it's as a builder, creator, or an investor, or a community member, or whatever, a curator. There's so much of this kind of community discourse or community-centric global scope that we love about Web3, and we want to take all the best elements that it has to offer and make sure that can help kind of drive forward the next 100 million people to come and participate, basically.
Wow. Yeah, this is brilliant. Absolutely. So, so quickly, I would love to get your thoughts on what is like the best use case that you've seen for NFTs so far, like, the one project or, a use case that you're really rooting for.
So so I've overthought a lot of this, obviously I spoke about that. And, I think there's, if I were to kind of answer in a cop-out a little bit, how I think NFT implementation will be going forward is, look, it's fun to talk about these crazy valued NFTs like, that are up in the clouds, but really it'll be at the the ground level, like the price points of like $0 to $50, where they have like isolated, really leveraged utility. An examples like, if you want to talk about, ticketing for a concert, like it's just more intuitive to put that into the form of an NFT than, a traditional like ticket, because, you can then leverage that ticket post attendance, like whether it's the POAP or it can be perpetual, it could be whatever, like a season's pass, and then that can be then, because you own it outright, you can then transfer it to somebody else efficiently, and you can give it to somebody else, and there's much more kind of community integration with that. But I think my favorite brick and mortar example, like I like to think of the most brick and mortar thing, like physical traditional thing that NFTs could be utilized for, because I love gaming, I love a lot of these other things like high leverage digital industries, but I like something really traditional and physical. And I think that an industry with just a little bit of infrastructure that could totally use NFTs in a huge way is something like the wine industry. When you have a vintage, right? Vintages they're barreled and bottled for, each year for the growth, right? So you have good years, bad years, famous years. So like 85 is a really good year. And like the pinnacle of wine for a lot of people is like the 80, it's like an 87 or 85, like Rothschild. Those bottles are insanely expensive, but they're also just apparently amazing or whatever. But the problem is that nobody knows in the market how many bottles in the world are left. They can assume that, like there are 1,000 bottles or 5,000 bottles or whatever, but each bottle that's sold in an auction or peer-to-peer is kind of traded off of that imperfect information.
Mm-hmm.
But if you had with again a little bit of physical infrastructure, the idea that with each bottle was assigned a unique NFT basically, and that when that bottle was uncorked, that NFT is then burned. The idea of then that basically that being a signal that bottle has been consumed to the world, that like one bottle being opened will always have an effect on the market because you're solving that information failure basically. And I can think of like whether it's vineyards or auction houses or like even individual collectors loving that concept of knowing the global like scope of something like wine, because it's so like each individual like year or for a vineyard like almost operates as its own like sub collection of like an NFT basically. And so if you know that there's only 1,000 bottles left of 85, then that's like that means a lot. That creates the scarcity. Absolutely. And those bottles are valued in a much different way. Now the challenge is that there's only so much the blockchain can do there. Like it can do a lot of it can assign the the unique addresses and everything, but in order for it to function fully, and this goes for a lot of NFT implementation, like it's not a software problem, it's a hardware problem. There needs to be some hardware like hurdle in terms of like physical infrastructure that needs to work to validate the then blockchain to basically function with the blockchain side. But yeah, I know if we clear that hurdle, there's so much like fascinating implementation use cases you can use NFTs for. And so yeah, I mean, obviously I'm like my hedge fund, we deal our primary assets in NFTs, so we deal in all leverage kinds, like whether it's PFPs or play to earn NFTs or like versus like high leverage creator coins basically. And we love all that implementation, but I like looking weirdly at if I were to take an industry that's as old as something as the wine industry and give it a legitimate use case for blockchain, I think that's something that I feel like they would jump for hand over fist.
Absolutely, something like what Vino is doing, I believe. They are putting in investment in wine, etc. I think on chain.
Yeah,
but
exactly.
I'm not sure. Yeah. That is like an interesting use case. Absolutely. Okay, so as I said earlier, that you're running short on time, but I will. This is like my last question for this particular episode, and this is something I ask almost everyone who comes on the show. So because this podcast is all about kind of making sure that the jargon gets out of the way, and people who are getting intimidated about Web3, blockchain, and crypto, they feel like, okay, this is like probably a devil that they can tame as well. What would be your advice for people who are like transitioning from Web 2 to Web 3, or people who how can they perhaps start living on blockchain?
Right. So it may sound a little bit strange because for me, I think I don't know if I did it in an atypical way, especially for a lot of quote unquote earlier guys. I wasn't nearly as early as some other people. So my advice always, especially when it comes to anything investment wise, is start with the tech and then work back to the asset. Now that sounds really scary, right? That's like crap. I need to start with the most complicated thing and then I can think about the product. No, I don't want you to think about it like that necessarily. I want abstract the tech as much as you possibly can. There are a lot of ways you can learn about blockchain just in terms of what it offers you as a consumer, like, or what it offers you that doesn't currently exist in the world. Like NFTs, for example. Like there's a million things that NFTs can do, but a really easy way to look at one use case for NFT is just, I want you to imagine you can, if you had the ability at any point in the world to know exactly where the ownership of a thing is. You know, if I sold 100 paintings or 100 apples, let's say, even whatever, I want to know who owns all of them and where they are in the world. An NFT allows you to do that at any time, right?
Wow.
Now, then it's like, okay, if I had that information, what can I do with it? And then that is where an element of utility comes into play. That's like, okay, that's how you can see something like Bored Ape Yacht Club, you know, leveraging their NFTs for like token gated events or token gated sales for the other side metaverse, you know, or, you know, whatever, like, you know, you can then start thinking about, okay, how is this project or this company using that like opportunity and leveraging that opportunity? And that's where you can get really creative and fun. Like, as new tech or whatever as it is, I really like to think about it as, from an economic standpoint and from a consumer standpoint, it's super old school. It's really still, Web3 is,
it's going back to the basics.
Yeah, it's more about the people, the projects, and the communities than anything else. And so, but if you want a good way to feel confident about what you're doing, is just try and start with what the technology, whether it's blockchain, like fungible tokens, you know, like Bitcoin or Ethereum, or non-fungible tokens or whatever, has to offer you, for your particular passion. Like if I'm a gamer, like if all I like is video games,
right?
You know, that is, you know, like I could, like, play to own is a great concept. Like I can now own the skin that I, you know, had. It's not like I'm paying for it. It's not some crazy vehicle to earn money. It's just, I have this thing now and I can do what I want with it. Like if I play World of Warcraft or something, like, you know, the concept of what it means to like own something in an RPG and what it feels like. And all like something like an NFT allows you to do is to solidify that even more. And so then it's like, okay, well, what kind of game would I want to see if I could do that for real? Like, and it could almost work in between games or something. And you know, so if you have a particular passion, just try and think about what those kind of opportunities, you know, how they can appeal to something like, you know, what you're passionate about. And then if you're looking to invest or get involved, go look out for the communities or projects or people that feel the same way and are kind of building something to fill that vision or to fill that, you know, that utility in that way. And then you'll find like the community for you. You know, for me, I started in VR, you know, design. And so one of the first things I used to do in college was I would repurpose video game models for something like VR chat. So I'd like rip a model from a video game and then re-rig it, reskin it, you know, customize it slightly. And then I go into something like VR chat in like a chat room and just hang out with my model. And it was kind of fun. Or I do it for friends or whatever. And that was a roundabout way for me seeing like a utility for something like an NFT. It's like, oh, if I, you know, created a model, like a rigged model, and then, you know, stored it, you know, in an NFT and then basically transferred its utility to whoever owned it, then it's like, you know, that's like an element of ownership, but then also identity. You know, it's like, okay, this is my identity in some ways. And that's just a really small use case, but that was something that I was passionate about. And that got me involved with people at, you know, Decentraland. And then that moved into the next thing, into the next thing. And then before I knew it, I was involved in the whole.
You're right. So, you know, like this is a very good piece of advice that, you know, find what you're where your interests align and go back to look at the tech and then perhaps go back to the token itself as well as the utility. This is good advice for people who are looking into investing. And it doesn't have to be intimidating, like you said. You need to sort of align your values with the platforms or your investments, and then it kind of all falls in place. So that is like really wonderful piece of advice, Rorke. Before we wrap this up, any parting thoughts?
No, I mean, I'm just really thank you again for having me on. I always appreciate having an opportunity to talk about, what we're building here and what we're trying to do, but then also just, everything that we like about the space. There's, we're not trying to be the be all and end all solution. Like part of what we love about, Web3 is that you can just be a node in the same way that like you have validator nodes and mining nodes, like on the actual blockchain. You could just be kind of a node, a component in the greater ecosystem. Like we want to help people out with a part of their lives. We don't feel like we're the solution. We know we're not the solution to everything. We know that there'll be projects that can do fine on their own. And we know that there are people that'll do a different thing. We know that'll people that'll use our platform that go somewhere else, and then people that'll come from somewhere else use our platform and go somewhere else as well. And we're okay with that. That's what we want to be that. We don't want to be something that pushes, themselves on users or tries to be like this one-stop shop for everything. Like, we can be a one-stop shop for a lot of founders to at a point in their lives, but we just want to be another part of the next stage of Web3 or the internet or the digital worlds. And we can occupy our little space and help some people out along the way, then that's all we can really ask for.
Yeah, that's true. That's very true. Lovely. Thank you so much, Rorke. This has been a very insightful conversation. I'm very excited for you guys and what you're building on Theia. I think this can be very revolutionary in terms of creating a very cohesive ecosystem for investors as well as platforms that are looking to raise. Thank you once again, and really all the best for all your endeavors.
Thank you very much. I really appreciate it. Thanks for having me on.